Real quick before we dive in, this isn't financial advice, this is just education. Trading is risky, so always do your own research. Cool? Alright, let's get into it. A lot of traders out there think Ichimoku is like super complicated indicator, right? Especially beginners. They look at those lines and clouds and go, nah, too messy. But guess what? They're wrong. Today, I'm gonna break it down into a super simple trading strategy that literally anybody can follow. Alright, quick rundown first. You've got those lines and this shaded cloud thing on your chart. Sounds fancy, but really it's just showing you areas of support and resistance. That's it. Now in TradingView, you'll see a bunch of different Ichimoku versions for free. We're not gonna mess with all of them. We're just gonna use the basic one called Ichimoku Cloud. Here's the trick though, and this is where we make it clean and uncluttered. By default, Ichimoku throws way too many lines at you. We do not need all that noise, so check this out. Go into the settings and disable everything except span A, span B, and the actual cloud. That's it. Nice and simple. You'll just see the cloud. No distractions. Now here's where it gets fun. The whole strategy is based on price breaking below or above the cloud. Let's do the bullish side first. Check this out. Price has been chilling below the cloud. That's bearish territory. But then it breaks above the cloud. That breakout is your potential buy signal. Basically, price is saying, hey, I'm done with downtrend. I'm ready to push higher. Now flip it. Check this out. Price is above the cloud. That's bullish. But then suddenly it breaks below the cloud. That's your potential sell signal or bearish breakout setup. Simple, right? Above the cloud, bullish. Below the cloud, bearish. And that's the core idea. We've stripped down Ichimoku to just the cloud, so you can actually see what's happening without feeling overwhelmed. Have you ever spotted a breakout like this on your own chart? Drop a quick yes in the comments if you have, and stick around cause in the next part I'll show you how to filter these signals so you don't get faked out. But here's the thing, not every breakout is equal. Some are solid, but some are straight up faked outs. So check this out. In this example right here, the overall trend is clearly down. But if you look closely, you'll see a couple of bullish breakouts, basically buy signals. They're popping up against the main trend. And yeah, those are the kind of signals that can trap beginners. Now, same deal in an uptrend. Price is pushing higher, but you'll still get random bearish signals that tell you to sell. And if you take those blindly, you're fighting the trend, which usually doesn't end well. So in just a second, I'll show you the filter I use to cut off a ton of those bad signals. But real quick, smash that like button, and if you want to go even deeper, check out my other playlist where I break down the swing arm trend indicator. Honestly, it's a really helpful free indicator on TradingView, which you might want to check out after this video. Alright, back to this strategy. The filter we're gonna use is called the market bias indicator. In my experience, I find it to be a more direct filter than using just moving averages, but we do need to tweak it a little to fit this setup. So here's what we do. Go into the settings, change the period to 200. Then scroll down and disable the HA option. Boom, that's it. So, how does it work? Super simple. Green means uptrend. Red means downtrend. And here's the rule. The rule I stick to is try not to trade against the trend color. If it's red, you're only looking for sells. If it's green, you're only looking for buys. Let me show you a clean example. Right here, the market bias is red. The candles are below it, so the trend is down. And that bullish breakout that popped up earlier, not valid. We ignore it. But then, watch this. The Ichimoku Cloud shows price breaking down below the cloud. That lines up perfectly with the red bias. That's a valid setup according to this strategy. Now risk management. We're not skipping that part. You'd place your stop loss slightly above the cloud or above the market bias or even just above the most recent swing high. Keep it tight but logical. And for the trade target, stick with a clean 1-to-2 risk to reward ratio. And of course, the same thing works in an uptrend. Here's the example on gold 1-hour chart. Market bias is green, price is sitting above it, so the trend is up. The bearish breakout of the Ichimoku Cloud, totally invalid, we skip it. But the bullish breakout that comes right after, that's a valid buy setup. And again, same stop loss rule, same 1-to-2 risk to reward ratio. And hey, if you wanna see another really helpful free indicator, check out the recommended video that just popped up on your screen right now. Trust me, you're gonna wanna add that one to your toolbox too.